What's going on, everyone? It's Business Network here. Now, you've probably heard the saying, the rich don't pay taxes. The wealthy have access to sophisticated strategies and loopholes that the average person might not even know about. But here's the thing, these strategies are completely legal. Today, we're going to pull back the curtain and expose these secrets. We'll break down exactly how the wealthy use the tax code to their advantage, and more importantly, how you can implement these same strategies to keep more of your hard-earned money. So if you're ready to level up your financial game and start paying your fair share, and not a penny more, then hit that like button and let's get started. Alright, let's kick things off with a strategy that's foundational to building wealth and minimizing your tax bill long-term capital gains. Most people are familiar with the standard income tax rates, which can go pretty high depending on your income bracket. But what a lot of people don't realize is that the government actually incentivizes you to hold on to your investments for longer periods of time. When you sell an asset like a stock or real estate that you've held for less than a year, any profit you make is taxed as ordinary income. But if you hold on to that same asset for longer than a year, you qualify for what's called the long-term capital gains rate. And guess what? Those rates are significantly lower than ordinary income tax rates. For example, if you're in the highest income tax bracket, you could be paying close to 40% on your short-term gains. But with long-term capital gains, that rate drops down to a maximum of 20%. Holding on to your assets for the long haul can make a significant difference in your overall returns. Now, let's talk about a strategy that's a favorite among the ultra-wealthy borrowing against assets. Imagine this. You've got a valuable asset, like a portfolio of stocks or a piece of real estate, that's appreciated significantly in value. You want to access that wealth, but you don't want to sell the asset and trigger a huge tax bill. So what do? Well, you borrow against it, of course. Here's how it works. Instead of selling your asset and realizing a taxable gain, you use that asset as collateral to secure a loan. The loan proceeds aren't considered taxable income, so you get to access your wealth without immediately owing taxes on it. This strategy is especially powerful for those who have built up significant equity in their assets. Alright, let's move on to a strategy that's often used by high-net-worth individuals and families, setting up private foundations. A private foundation is essentially a legal entity that you establish to hold and distribute charitable donations. You fund the foundation with your own money, and then you get to decide how those funds are used to support the causes you care about most. When you donate money to a private foundation, you get to take a tax deduction for that contribution. The money you donate to the foundation grows tax-free. That means your charitable dollars have more power to make a difference because they're not being eaten away by taxes. So not only are you making a positive impact on the world, but you're also creating a lasting legacy for yourself and your family. Now let's dive into a strategy that's a bit more controversial, but incredibly effective for generational wealth transfer, the buy, borrow, die strategy. This strategy is all about leveraging the power of the step-up in basis loophole. When you inherit assets from someone who passes away, the value of those assets is stepped up to their market value at the time of death. Here's why that's significant. Any capital gains that occurred during the original owner's lifetime essentially disappear for tax purposes. Let's say your parents bought a house for $100,000 many years ago, and it's now worth $1 million. If they were to sell that house while they're alive, they'd owe capital gains taxes on the $900,000 profit. But if they were to pass away and leave the house to you, the value of the house would be stepped up to $1 million. The buy, borrow, die strategy takes advantage of this loophole by encouraging individuals to buy assets, borrow against them, and pass them on to their heirs with a stepped-up basis. Finally, let's talk about a strategy that's all about working smarter, not harder tax arbitrage. This is where you strategically shift your income from higher taxed vehicles to lower taxed vehicles, effectively reducing your overall tax burden. One of the most common examples of tax arbitrage is investing in retirement accounts like 401ks or IRAs. These accounts offer significant tax advantages, allowing you to defer paying taxes on your contributions and earnings until retirement. When you contribute to a traditional 401k or IRA, that money is deducted from your taxable income for the year, which means you pay less in taxes up front. And as your investments grow within the account, those earnings are also tax deferred. Another example of tax arbitrage is investing in private placement life insurance policies, or PPLI. The key to tax arbitrage is to understand the different tax treatments of various investment vehicles and to strategically allocate your assets accordingly. So there you have it. 5 powerful tax strategies that the wealthy use to keep more of their hard-earned money. Remember, these strategies are completely legal and accessible to anyone who's willing to take the time to understand them. It's not about avoiding taxes altogether, it's about optimizing your tax situation so you can keep more of what you earn and achieve your financial goals faster. As always, it's important to consult with a qualified financial advisor or tax professional before making any major financial decisions. Thanks for watching, and I'll see you in the next video. Stay informed, plan wisely, and take control of your financial future. At Fiscal Integrity Group, we bring lights to your finances.